If you have an 80% loan and the values go down 20%, you have no value left in your property anymore.
Jeff Gleiberman is the president of MG Properties, a vertically integrated multifamily firm with more than 33,000 units, transacting up to $2 billion of acquisitions every year.
We do everything in-house, actually, and that's been a huge key to our success. So we got asset management, property management, construction management. Every year, they were always like, interest rates are going to go up. They kept going down, down, down.
Till it wasn't.
Yeah, exactly. That was the big awakening. Real estate's very cyclical. It goes up and down for many different reasons that are unpredictable, and we've seen many cycles. I think that getting reps and fully understanding what you're getting into is going to be the most important things. The office market is extremely depressed right now. We really feel there's been something that's been lost with the work from home. There's like a saying in the industry that's going around, heaven in 27, and that is what we're feeling as well. We truly love our business. My father will never retire. I plan to never retire. We want to do this till the very end.
This episode is supported by Citizens Private Bank. Citizens believes your attention is a force. It's built your world, your vision, your legacy. But wealth brings financial complexity that can consume the most valuable asset, your focus. That is why Citizens Private Bank, now in Los Angeles, gives you a dedicated team with one point of contact who understands your full financial picture, including specialized real estate financing. I'm a client myself, and I have been impressed by how seamlessly they bring everything together with thoughtful, tailored support. Let Citizens focus on your wealth so you can focus on your world. Connect with a banker at citizensbank.com/no vacancy.
Member FDIC, equal housing lender.
Hey, real quick, if you've got parking assets that aren't making you money, you got to check out ParkUp. These guys work with property owners and managers to fill your empty spaces and turn them into a real revenue stream throughout their platform. Or if you don't even want to think about it, they'll straight up lease the space from you. Guaranteed money, no headaches. Either way, you win. Go check them out at parkup.io. Seriously, it's a no-brainer. On today's episode, we had the wonderful Jeff Gleiberman of MG Properties. It was an incredible conversation. This is all things institutional real estate. They have 33,000 apartment units, are buying billions of real estate a year. We really dove deep into the specifics of the structures of how they structure deals, their capital stack, opportunities they're looking at, how they have and run a 1,000-employee company. It was an incredible conversation, and I hope you enjoy the episode. Welcome to the show. My name is Taylor Avakian, and I am here with my esteemed guest, Jeff Gleiberman. Jeff, thank you for being here.
Thank you for having me. Happy to be here.
All right, cool. So I talked to you before this. You've been on some number of podcasts, and you've given your background on MG a bunch, but just for like the 30-second overview, give me MG and give me the company's history a little bit.
Sounds good. We are a vertically integrated multifamily investment firm that was founded by my father, Mark, in '92. Been in buying and managing and investing in apartments for the last almost 35 years. And we started in San Diego, where our family's from, and we've branched out now to 7 states. The current portfolio today is 33,000 units, and we've grown the company to 1,000 employees, which comes with a lot of things to deal with. And we've been extremely active the last couple of years with acquisitions and dispositions. So happy to dive into anything that would be of interest.
Are you guys self-managed? Do you manage all the portfolio in-house?
Yep, self-managed. We do everything in-house, actually, and that's been a huge key to our success. It's something that we take a lot of pride in. So we got asset management, property management, construction management, and we have all specialty departments under them too. So we have a legal team, special tax team, marketing, and we can really focus on every detail at the properties.
Mm-hmm.
And then it also teaches you so much about the submarkets and the properties that you want to buy and invest in.
Was growing the company as big as it is, was that something your dad had envisioned, or it just kind of like happened?
Never could have imagined it.
Really?
Yeah, that is for sure. Yeah, he was an accountant. He saw tons of tax advantages to real estate. And so he's like, I want to start investing in real estate on the side. So he did a 4-unit community by himself.
Mm-hmm.
And then he's needed to get some more capital. So he's like, I'm going to go to some friends and family. He went to both my grandparents, to two of his friends, got four investors, bought a 38-unit deal in Vista
Okay.
in North San Diego, did very well. And then we just kept growing it from there. He left his accounting job, started running the business out of our house. I was 5 or 6 at the time, so really got to see the business from the very, very beginning and got to work in every aspect of the business. I started with leasing and maintenance.
Oh my goodness. Geez, 33,000. That is so many units. To be built over, what is that? Like a 30-year time period, basically?
Yeah, just over 30 years.
Man. And so the structure of what you guys do, is it, I'm sure now it's more institutional investors, or what does the actual cap stack look like? I think you said last time I listened, 2,000 investors or something like that in the Rolodex LPs.
Yeah, so we have about 2,400 individual high net worth investors. And it started with family and friends, and it kept growing word of mouth, similar to how we grow it today.
Yeah.
And then once a few family and friends tell more, and it's kind of been growing a lot over the last couple years.
Sure.
Yeah, for the first 20 years, it was all high net worth syndications. And then starting in 2010, it was coming right out of the Great Recession. It was difficult to raise equity.
Mm.
And so we started to explore institutional options as well. And so we've been doing institutional equity as well for the last 15 years.
Okay.
And that's been 30% of our business. 70% is private high net worth syndications. 30% is institutional JVs.
And do you determine which bucket of capital to use based upon the investment? I assume it's like, okay, this is a great for a pension fund or CalPERS or CalSTRS. I don't know your partners, but this will be a good asset for them versus we're trying to get a higher equity multiple or a higher cash flow or IR, whatever the metric that the private investors look like. Is that how you know which bucket to dive into?
That is the main reason. And the second one would be the deal size.
Okay.
So our high net worth group is focused on the cash on cash return, the yearly distribution.
Okay.
With depreciation and the passive losses, that's all tax deferred. And that is a big driver of the investment for our high net worth syndication model. The institutions are more back-end focused, IRR, total return, multiple focused. So that's the main driver. And then on the deal size, we typically, if it's above a $200 or $300 million purchase price, we'll go for an institution that has larger pockets, more equity. We can raise up to $100 million of equity on a private syndication.
Jeez.
Which gets you to a deal size of around that 200 to 300 million.
Man, what's the drawbacks of going institutional that I think maybe people wouldn't expect? Or I think I know the answer, but what is your thoughts on why someone wouldn't want to go the institutional route?
I would say from an GP, from an owner perspective, we
Yeah.
prefer private because you have more control.
Okay.
And the control is the main thing that you lose when you are going with the institution that wants to retain major decision rights, buy, sell provisions, other things as well. So these large institutions, they're very smart. They have a lot of money. They do many different things. They might need to sell your deal at a time in the market for a reason that has nothing to do with you. They might have liquidity issues from a fund that has too much office that you didn't have anything to do with. And so you just lose some control and there's some decisions that might not be made that we think would be the right decision.
Yeah, limiting. I mean, when they got to press the red button, eject, and you're like, well, no, it's not the right time to eject. Like, trust us. Like, here's the market. Here's where we're at. Give us 6 more months, or we're about to reposition this stuff, or we can shake some things around, get creative with it. And they press that button. You kind of have to move with that.
Yeah, and it's kind of top of mind right now, and that's why I mentioned it. So for our first time, actually, we have an institution. Their fund is coming to an end, and they want to sell a deal that we bought with them about 6 or 7 years ago.
Okay.
And we they have the major decision. So we said, if you want to sell it, we'll go with the sale. But we would not like to sell it. We think the market's going to recover. If we put some money into the deal, it's going to do really well. And we're actually doing our first recap.
You're doing recap.
Yeah. So
Okay.
so we'll be bringing in private investors into a deal that we owned with an institutional partner, and we think it's gonna, turn out really well. We know a lot about the deal. We've owned it for a long time. Like the market, the market's starting to recover. So that might be an opportunity for us going forward.
Yeah, it's I've read or listened to, I forget which one it was when I was watching your shows, but you guys have never lost money. Is that still the case?
That is still the case as I sit here right now, but this will be our first loss.
Okay.
Yeah, so this will actually be our first loss. It's with an institutional
Okay.
investor, so we haven't lost any money with
Yeah.
the private investment group. Don't plan on it.
Yeah.
Sometimes I mention institutions have different reasons
Yeah.
to sell. So yeah, we will be selling at a loss, our first one with this deal, but we will be recapping it, bringing in new equity, and hopefully still having a successful story in the end.
100%. No, it's crazy that they're willing to just do that, right? But again, there's bigger levers in play
Yeah.
when these big institutional firms, and they have their own timelines. And I would say more from like a perspective of being able to say you've never lost money, right? You can still say you've never lost money from the institutional investor side of things, which I think is probably more like more valuable than these institutions, because again, you don't have the button to be able to really have full play over this stuff.
Yeah, and there's just a lot of things that are in your control, but there's also a lot out of your control. So if you can try to focus on mitigating the risk, on doing downside protection,
Yeah.
you should be able to make it out, pretty safe. And luckily, we haven't lost any money yet, and really that has to do with long-term fixed rate financing.
Yeah. So of the loans that you've done, I think I listened again, I did some research, but you've done maybe 3 floating rate debt deals and most everything else has been fixed rate.
Yeah, on the current portfolio right now, most institutions use floating rate debt.
Yeah.
So on the institutional side, we use a lot of floating rate debt. On the private side, we have 2 floating rate loans on our portfolio of roughly 100 plus properties.
Okay.
And we almost always will get to a long-term fixed rate loan, and we would prefer to put the long-term fixed rate loan on immediately.
Why would an institutional want to do floating?
Chasing yield. Yeah, so floating rate loans.
Historically have outperformed fixed rate, right? If you're looking from a yield perspective.
Yeah, so we were kind of wrong for 30 years in a row. Interest rates went down since we started our business
Yeah.
and before. For every year, they were always like, interest rates are going to go up. They kept going down, down, down till
Till it wasn't.
yeah, exactly. And that was the big awakening. So that's when we started to look pretty good.
Yeah.
But the 2 reasons are there's yield maintenance defeasance, prepayment penalties on these fixed rate loans. So the institutions don't want to be caught with those. They want the ability to sell and move. And then on the variable rate loans, you can typically get higher leverage, and that can help with your IRR. So that decreases the cash on cash, but it'll help with your total return, and that's what the institutions are looking for. So most of them do floating rate loans. Some do fixed, but I would say most do floating.
Are you looking into the future of where MG wants to go? Do you see yourself wanting to continue to do more of the institutional stuff, still have a balanced mix? Like in a perfect world, what do you see the future for the company looking like from that mixture?
There's a lot of benefits from having both. And I think we found a very good balance now with the 70% private, 30% institutional. And I plan on keeping it that way. And there's times in the market when the private investors dry up. There's times in the market when the institutionals dry up. And then it's just good to have as many relationships as possible. We buy and sell from institutions all the time. So we want to have those good relationships there. With our portfolio now, 33,000 units, we're transacting $1 to $2 billion of acquisitions every year. We get opportunities that others don't see off market. We know deals that have traded in the past, and they're not always going to fit for our private group, and they're not always going to fit for our institutional clients as well. So just to have the ability to do good deals and have both buckets, that's our long-term vision.
Let's talk about what we talked about beforehand of some recent trades that you guys have accomplished here in Los Angeles. You sold a couple buildings and then you bought recently a building in Dallas. So talk to me about the sales here in LA, why you sold those and what that looked like, maybe some buyer profile stuff, and then why your first acquisition and soon to be something else in Dallas.
Yeah, no, I will for sure. And we sit here in LA, so I'll focus a little bit on LA, but I'll give a little higher level view first. So this year we'll close about $1 billion in transactions.
Okay.
We were targeting 1.2 billion, which we knew was a little aggressive in this market. There's just low trades today, and the interest rates are really volatile, and there's some headwinds against us. But we started the year off with our second biggest transaction. It was just over $300 million. It was a high rise in San Diego. We've closed 4 other deals since.
On acquisitions?
Yeah.
Okay.
Yeah, we've bought 4 other deals since, and we have 4 under contract to close by the end of the year. So it's been a very successful,
Wow.
active year. We sold 5 or 6 deals this year, and 2 of them were in LA. Yeah, and both of them actually went to buyers that are doing the NOAA, naturally occurring affordable housing program. So they've been very aggressive buyers and really kind of saving the California market right now. And for us to buy in LA today, it would have to be a very, very special, unique deal. There's just a lot of regulation risk with the mansion tax that really put a damper on the market. And LA is just a market that we don't know if we want to have tons of exposure to. We still have a decent amount of deals left here, and we'll ride them out, obviously, and they're doing fine. Actually, they're performing well on the way that rents are going. It's just their values are down.
Isn't it funny how the rents are going and increasing in Los Angeles? However, everything else is going down and the sentiment is going down. And it's been a common theme, I would say, from the conversations that I've had daily on the phone when I'm selling apartments to these owners, but also just when I'm talking to institutional owners. And it's like, yeah, not very many people have a strong-willed belief that Los Angeles is the place where they want to put their hard-earned cash. Do you talk to the people who are making these decisions? Because you guys have, I feel like, a lot of sway or have enough, leverage to be able to say, hey, like, we're gonna get the F out of here, right? Like, what are you guys doing? Why are you making all these changes and things to make it harder for us? Or maybe when you're talking to other institutional owners, like, is it the similar sentiment? What is going on at the top?
Yeah, there's a lot of industry groups that are getting together and really trying to rally for what we believe is right in the regulation and in the market, but it's really difficult. And there was the prop that almost passed for rent control,
Yeah.
which that was a big fight, and luckily we
Thankfully,
won.
we
Yeah,
beat that.
yeah. So, and I'm sure there'll be many, many more to come. Just even investor interest in California
Mhm.
has been going down as well. So, the number one thing that I hear from investors is we prefer not to invest in California. And these aren't necessarily real estate experts. They're trusting us to make the right
Sure.
decisions, but it's just what they're reading, what they're hearing, and just the way they feel.
Yeah, the sentiment around it. Really, that's what I've noticed too. It's the cloud. It's like not even reality. Like you mentioned, LA is performing the best from a return perspective on your assets that you have here, but it's the sentiment. It's like people don't want to get into a falling knife situation or burning, city from the outside or from the inside out. It's an unfortunate thing that I'm hopeful that things turn around and change. But even myself, as someone who wants to continue to invest in apartments, I know the market for the deals that I have like better than anyone else. I feel very confident that if I saw a really good deal, I'd know how to execute on it. And I'm asking myself, okay, do I want to put my money in this market that I know so well, right? So it's hard to have that fact be the truth. But we talked also. You just started buying in Dallas a little bit.
Yeah,
So
yeah. So yeah,
why that's a new market for you guys?
it is. Yeah, and we were talking a little bit before too. Yeah, and you mentioned it that over the last 6 months, Los Angeles has been one of our best performers from a rent growth standpoint, but still really, really hard to invest here. We are we added a new market. So every 5 years, we've been adding a new state. The last one we did was Colorado about 5 years ago. We did Oregon about 5 years ago before that. So it's been kind of a model. I think over the next 20 to 30-year vision, we'd love to be nationwide and be in every market just so we can take advantage of, whatever's going to happen in each market. And moving a little bit out of California, we're going to a much more business-friendly, owner-friendly state. And we picked Dallas. So our first one closed about 3 months ago there, where we have our second one under contract right now. But talking about where investors want to be, investors really want to be in Texas, in Dallas, and that lowers cap rates. So cap rates are significantly lower in Dallas than they are in Los Angeles, which
Yeah.
you would think maybe should be the opposite, with just the way that the land is and the
Yeah.
ocean and the valleys. It is
It's kind of
pretty,
crazy
yeah, it's really
when you
crazy.
think about it. So when you go into a new market, what does the process look like for you guys to determine, okay, this is the one we're going to go to? Is it the investor saying, hey, we want you to go look at Dallas? Or is it, hey, let's go study the market? I mean, you have 33,000 apartment units of data. I know not in a new market, but what does the process look like for you to want to go explore a new market and say, hey, this is where we're going to plant our new flag?
Yeah. So yeah, we have 130 people in our corporate office. About 11 of them are on the investments team looking for new acquisitions. And we have deal leads that cover different states. We have our CIO, Paul Caseberg, and then we have analysts as well. And so every year we do new market studies, and we target different areas that we monitor for about 5 to 10 years before we enter. So we're mostly looking for job creation. That's
Yeah.
going to add more renters. And then we're looking for submarkets that don't have a lot of supply. So we're not going to have to compete against a bunch of new lease ups. And so the main targets that we've had recently have been North Dallas, where we bought our first deal in Richardson. And the second one's being bought right by the Galleria. And another target market for us is Boston. We would love to break in there, have not yet, but that is a next target market.
That's a rent control market. isn't
Yeah,
it?
yeah, it definitely has similarities
Uh-huh.
to California. Not as bad, but definitely a lot of similarities.
Yeah.
But also very, very high incomes, very little new supply, and a lot of things that we like to.
Okay. And from the metrics you said, so when you're competing against the big boys, right? Because on these big deals, like you're competing against the Blackstones, the Starwoods, the Bob Harts of the world, True Americas. Like, how do you win deals when you're competing at that stage?
The same way that we kind of founded our business around our reputation and doing what we say. So we do tons of repeat business with the same sellers. We always want to stick to what we say we're going to do. We do enough due diligence before we put in an offer that we know what price we're going to pay. We've done, over 100 transactions over the last
Yeah.
less than 10 years. And so really that reputation is so important in business, and especially in our business.
Do you need brokers at that level? Like when you're trading hands between institutions, right? Like, I guess the process is for you to create a market, but if everyone knows their price, wouldn't it just be like an internal attorney just like negotiating this stuff? Why do you think that brokers are important?
Brokers are very important. We always use them, and we always will.
Okay.
And they have a lot of market knowledge. We use them for market research. But it's different when it comes to our world, for sure. Very good question. We do not use buy side brokers.
Okay.
Only selling brokers. So I haven't heard of a buy side broker in like 15, 20 years.
Yeah.
But on the selling side, for creating the market, the marketing materials, also brokers are just really, really helpful in finding deals and connecting with other equity and many things. And we want to keep them happy. And,
Yeah.
and it's an old tradition and we follow a lot of old traditions at our company since we've been around a long time. But my father always taught me, you sell with the broker that brought you the deal. And we always have kept that tradition, and it's worked out well for us. And hopefully they'll bring us more deals and connect us with more investors and people as well.
We appreciate that. We appreciate that when that is the case, because I've had it be the other way, and it's just like, okay, if that's what you want to do, right? Like there is power, and again, we're in different ballparks. I'm more smaller middle market stuff, but even then, it's I will be continuing in the business. So if you intend to invest whatsoever, continually, like I will not forget what had occurred there, right?
And we believe that as well. I mean, it's a very long-term business. It took us a long time, almost 35 years to get here.
Yeah.
And hopefully we plan to have another 35 plus years. So we want to keep the relationships and our reputation.
What's something that people wouldn't expect when it comes to running a business as big as yours?
I would say, the importance of the family feel for us.
Mhm.
So we're a family business. My father still works every day. We work, aside each other to grow the business and make strategic moves and find good properties and good investments. But as we've gotten larger, it's been harder to keep that family feel for our team members, for our employees, and that's something that we really try to do. So I mentioned to you that I planned this week in LA to get a lot done, and I came up yesterday. And every quarter we go to a different region and do a state of the market and talk about where our company's going. So I met with about 120 of our on-site professionals, the maintenance, the management, and really trying to let them know our vision so they can help us work towards our common goal of the best performance and that really the best returns for our investors.
What is the leverage that you have at your size when it comes to negotiating with maybe lenders or banks, or like, is there any benefit to having your size when it
Oh,
comes
yeah.
to like that leverage portion of it?
Yeah, for sure. Massive, massive benefit for both Freddie and Fannie
Okay.
on the borrower's channel list. So being on their list of their most active borrowers.
Mm-hmm.
So we have a representative with each of them, and we get very, very good terms, spreads, rates. So we actually locked a loan today.
Mm-hmm.
It was a 7-year fixed, just over 60% leverage at 4.83.
No way.
Yeah, so really, really good. We're still getting really amazing long-term fixed rate financing. No one can compete with
Sure.
Freddie and Fannie. They're just really giving up
Yeah.
some amazing loans. But yeah, that's because of our size, our relationship, the amount of deals that we do, and our portfolio with them.
Man, that's pretty crazy. I haven't heard a four handle in a long time. Man, so I guess speaking of that, where do you see the market headed? Are we headed towards, I know there's a lot of talk of interest rates cuts and, but then there's inflation and you guys probably have, again, you said 11 analysts looking at deals. I'm sure you have more people studying markets and understanding the economics of what's going on in the macro market. Like, what is your number saying? What is your data telling you guys?
Yeah, there's like a saying in the industry that's going around, heaven in 27. And that is what we're feeling as well. So I know it's a common thing that people are saying, but just with all the new properties that have been delivered
Uh-huh.
and how they're being absorbed right now, we've got another year and a half of slow performance and then maybe a year of okay. But then once this new supply is all absorbed and there's been no new deliveries, we're going to start to see that good rent growth again.
Mm.
And we're already starting to see expenses go down. The labor market, which was one of our biggest increasing expenses, has calmed down as well. So, um, for property performance, heaven in 27.
Okay.
For interest rates, we don't see too much movement over the next couple of years. They're probably going to stay elevated like they are.
Yeah.
Maybe slightly go down, but stay about where they are right now.
So do we see average cap rates trading in the fives still? Do we see them compressing to the crazy numbers that they were in 2021 and 2022 and the threes in some cases? Like where do you see the playing field level out?
Today, we're seeing most well-located, well-built, institutional quality multifamily trading in the 4.75 to 5% cap rate.
Okay.
We do expect that for another year or two, as I mentioned. And then once the market starts to improve and things are more stable and more investors have come back, we do see it going slightly lower, but not to the
Yeah.
crazy threes or sub 3 days.
So you're not underwriting a crazy amount of projected rent growth for these deals to work in pencil. Like, you're pretty conservative when it comes to the underwriting of how you guys look at these deals.
Yeah, we kind of focus our historical averages, which over the last 35 years, we've seen about a 3 to 3.5% average rent increase per year
Okay.
over a 10-year period. You're going to have some negative years, some positive, some okay, some really good. But on average, we're seeing about that. And that's what we like to put in for our average 10-year hold. And that we focus on kind of long-term 10-year holds.
With all the data that you have, do you have any specific systems in place? Do you have any custom software? Do you guys have some analytical juggernaut in the background, like combing through all this data to make the investment decisions? Like, how do you guys use the swaths of data, or do you use it, or are you looking to use it with all the advances in AI?
It's been a big competitive advantage of ours. We can look at what submarkets are performing best for us and call owners and find other investment opportunities there. I think our biggest way that we use the data is we've been very blessed that we surround ourselves with good people that we work with. And we've got many team members that have been with us over 15, 20 years that just have so much history with us, and we work together so well. And um, that's one of the most important takeaways is who you surround yourself with.
And the team members and whatnot. Are you exploring AI at all?
We are exploring AI for prop tech, property performance, property management,
Okay.
and a little bit on the investment side. We really kind of trust our own model that we made and our own list of things that we look for. So not as much on the investment side. I do know something will happen that it'll help us be more efficient. I haven't seen it yet, but on the property side, we're using an AI bot that helps screen residents.
Elise? Are you using Elise?
Yeah, we use Elise AI. That
Elise
one's
AI.
for the phone call.
The
Yeah,
calls, scheduling, and stuff like that.
that's really good.
Elise.
Yeah, I mean, you can call it midnight and now just schedule anything you want.
Yeah,
It's amazing.
which is crazy,
Yeah.
right? I mean, when you guys go and renovate a building, what are some of the things that you're doing to the property to get it to the MG quality? Like, what is? I guess you go in, you buy a older, for the smaller stuff, mom and pop, right? Maybe, or an institutional. Like, what have they not done that you guys can do to improve it? What do you do to the buildings?
We historically have had two business models. So we have a value add model, which is properties that are 10 years or older,
Okay.
and then a core plus one where properties that are 10 years or newer. And we're doing a little bit less there. We're just kind of focusing more on purchasing in the right market, a very well built property, and then managing it correctly and having some efficiencies. We have done renovations up to 80, 100,000 per unit where we've put in washer and dryers. We've completely redone gyms, clubhouses, pools, kids areas. We've completely done the interiors, obviously the flooring, the lighting package, and the fixtures and the appliances, and then smaller ones as well. So it's really deal by deal, and we want to focus on making sure we're not over improving. So we'll study the market extremely well and make sure that we can put in the least amount of money that's going to get us the most return. So it's really, really sub-market specific, deal specific. On average, I would say we're doing mostly appliances, flooring, hard surfaces, cabinet fronts, and then a lot of common area amenity spaces, but not going super deep in them. Mostly, I would say furniture and new equipment and new cabanas, just more on the looks.
Yeah, the visual resident experience, stuff like that.
Yeah.
That makes sense. Why have you guys dove into more ground up? Why is it mostly value add?
A little bit of my father's personality,
Okay.
and he wants to be an expert in whatever he does,
Nice.
be the best at it, and focus on one thing and be super, super focused on it. And that's the way that we built our company. So we only buy existing apartments. That's all we've done. We've done it 220 plus times, and we want to make sure that we are the best at that. Also, we're a little risk adverse. We do 60 to 70% leverage. We're not going crazy on the leverage. We're doing the fixed rate loans, long-term holds. The development world brings in a lot of risk and a lot of assumptions, and it's not really in our playbook. So those are the two main reasons.
Do you ever see yourself doing sort of spin-offs or different branches of the company, or like maybe a tech arm, or you guys are doing third-party management, or you spin out a development arm? Like, do you have envisionment for having different branches like Related does, or Blackstone, or anything like that?
It hasn't been in the vision. Every year we have strategic planning where we bring in an outside consultant and they kind of bring up these topics and what can you be doing better and what can you be exploring. And really, I think our company's success has been built around being experts in one thing, and that's the way we want to keep it.
What's the best deal that you've ever done?
That is a very good question. There's been a few of them, but there is one in San Diego that stands out. And the There's one in Reno that stands out as well. So yeah, there's a 255 unit deal in the Midway area, close to the sports arena in San Diego.
Okay.
Just really, really good purchase the time we bought it, the
Yeah.
price we bought it. And we did a big value add there, massive one. That was one of the larger ones we've done where we put in the washer and dryers. We added a resort style pool that we took out the tennis court. We completely took all the laundry rooms out as well and made big gyms and a bunch of amenities. And it just was a really, really big success story, huge return for our partners, and just really, really good deal. The Reno one was an early Reno buy in 2012 before Tesla moved there with their Gigafactory for the batteries. And just amazing purchase. I think we purchased it at right around 80,000 a unit, and then we sold it for over 300,000 a unit. Yeah, just a few years later, after the market really took off, we put a really nice renovation plan on that one. It had great cash flow. Those are two that are standing out, but there's been lots. I love thinking about the good deals. It's so fun. Yeah.
The good ones are the ones where you smile and you're like, man, if I could just have a bunch of those, that would be incredible.
Yeah.
But it's like, it's you don't get grand slams every time you go up to bat, right? You guys are playing this for the long game. So I think consistency is probably something that you guys pride yourself on. And is your dad and yourself, are you guys very systems oriented? How are you a deal junkie? Like, what is your personalities within the company making the decisions? Because are you guys similar in the way you think? Do you balance each other out? What is it like working with family and the dynamics of how you guys think?
Yeah, it's been really amazing working together. It doesn't always work out, but luckily we've got different personalities, so we take different tasks on, and we love working together. I saw him build this business. We worked together when I was a kid growing up, and then when I came back around 11 or 12 years ago full time, I went to CBRE for a few years to get some experience outside the business, and went back and got my master's. But when I came back, I think we had around 10,000 units. So, we were about a little less than the third of the size. And we just said, we've got an amazing platform. We believe in what we're investing in, and we know we can grow this business. So we think very similarly, but we also do different things too. So it's just been it's been really great working together.
What does your day-to-day look like? Like, what is your responsibilities?
I spend a decent amount of time on fundraising.
Okay.
So, typically in the beginning of our business, the fundraising was the most difficult part.
Yeah.
And it's still difficult today too, but that it's changed as the years have gone on. That's not the more difficult part. Now the more difficult part is finding the good deals. But do a lot of fundraising, both on the private side and the institutional side. Do a lot of industry outreach, trying to connect to get off-market deals and find good deals, and then company strategy. So, what departments can be more efficient? What can we bring in-house? What could we outsource? And just a lot of really kind of fun company strategy stuff.
Do you live in spreadsheets, or are you more above that and have
No.
other people?
We're looking at a lot of spreadsheets.
Okay.
Yeah, and I brought
I was gonna say.
I brought my investment committee memo, which is just full of spreadsheets. We're looking at tons of deals every week. I mean, we probably analyze 700-800 plus deals a year. The goal is to buy the 15 best. So it's really just impossible to time the market. You never know what the market's going to bring.
Totally.
But if you're buying well-built, well-located real estate, you're going to have a good return. Your investors are going to be happy, and you're going to grow a successful business.
What are some things that are red flags for a deal? Like, you're walking a deal, right? I assume you guys walk all of the properties that you're going to buy. Like, what are you looking for? What are the big things that really could mess up a deal for you guys, or that you in your experience have made it a good deal, a bad deal, or it came up after you guys closed? Like, what are the pains that you've had to learn from that you were very focused on when you're looking to acquire a deal?
In the multifamily world, we believe there's a price that makes sense for almost any deal, but we do have a long list of things we do not prefer. So I'm not going to go through them all, but
Sure.
galvanized plumbing, asbestos, washer and dryers not in the unit with no ability to put them in, heavy crime areas. So we have a long list of things that we try to avoid.
Mm-hmm.
Sometimes we'll look at deals that have these features, and price would just have to reflect it and the returns would have to reflect it. But there is a long list of things that we've built throughout the years and lessons that we've learned just from, owning so many different types of properties in so many different areas.
Where do you go to continuously learn? Like, where do you go to improve your skills? How do you guys stay sharp?
We try to stay in front of as many trade organizations as possible. So I was just at ULI, which was in San Francisco,
Yeah.
3 weeks ago. A lot of interesting stuff there, talking about AI, where the market's going, where the inflows of capital are coming from. A national multi-housing conference, our biggest trade organization we're very involved in, local ones in each area, and really just trying to, stay on top of the trends in the market and what we're seeing with new supply, job growth, all those different things.
Do you feel like you're a trailblazer, or you guys are like the second or third person to see what those people are doing, and then you can go and capitalize it because you have the leverage, you have the size, the scale, the advantages that maybe some of those new players don't have?
I think that we are willing to be trailblazers.
Okay.
We're probably, if you look back historically, we're maybe not the first ones to make moves, but we definitely want to monitor them and make sure that they work. So there's companies out there that are going completely peopleless at their properties right now. I believe Essex and UDR, they're two large REITs. I believe a lot of their properties do not have leasing and management on site anymore. It's just all done through apps and kind of virtually. Obviously, they need maintenance people,
Sure.
so we rolled out moving our assistant managers to the corporate office, and they could cover more tasks from there. And so we have almost done it throughout the whole portfolio, moving the assistant manager to the office, and it's saving a ton of money.
Yeah.
And there's some growing pains with it. Our managers are getting inundated with lots and lots of residents, so
Yeah.
they need a little extra help. But it's been a big, big savings, and I think it's been a really good move.
Yeah, that's super interesting because at the size that you guys are at, right? It's like if you save a penny somewhere, that's a big thing at the bottom line.
Oh yeah,
Right?
yeah. We try to say that all the time. And every pen, paper,
Yeah.
it adds up. I mean, there's
At the scale, you said you have 1,000 employees?
yeah.
Dang, man. I heard that they're in California, in Los Angeles specifically, which you're headquartered in San Diego, so I don't think it affects you there. But in LA, they're trying to do a tax on, it's like a wealthy tax, but it's for businesses over, I think, 100 employees or something like that, where they would tack on another 5%. I'm like, what is the logic behind any of this stuff? Like, it doesn't make any sense to me from that perspective. So yeah, like a company like your size, you would just pick up and move. You go wherever you need to go.
Yeah, and if it's just in LA County, you just move right to the Inland Empire.
Yeah.
I mean, you
Just
move.
go right outside.
Yeah, exactly. So it's just there's been some interesting business decisions in LA for sure. And again, as we talked about earlier, one of the reasons that we really feel like you need to be paid a lot to invest
Yeah.
in LA, and we still underwrite everything here. We look at it, but we haven't seen those returns that we like in LA in many, many years.
What are the metrics that you guys are shooting for in terms of IRR and equity multiple and cash on cash? Like, what do those numbers look like?
Yeah, sadly, we wish they were a little higher because the market is very efficient. There's
Yeah.
a lot of capital chasing our deals, but today we're seeing kind of low teens net returns.
Okay.
So we're seeing 11 to 13.
That's after your fees.
Yeah,
Okay.
yeah, net to our investors, and we're seeing cash on cash in the 4.5 to 5.5% range.
Okay.
Usually starting off around 4%, ending somewhere around 6%, but that average is at 4.5 to 5.5%.
We have a sponsor for today's episode, and that is AI for Siri Collective. 25 listings at the moment. We're closing 4 or 5 deals a month. It's been incredible. So if you want to learn, if you're in commercial real estate, how to use AI in your business, whether you're a property manager, a broker, an investor, really anyone, we have a huge group, over 400 people in this community. And the website, if you want to go check that out, is aiforsiricollective.com. So appreciate you guys. Now back to the episode. And are you guys doing 80-20 on LP, GP? Do you guys contribute capital? Like, what does the actual capital stack look like? And then the waterfall distribution that you guys typically set up?
Yeah, two really good questions. one thing that has been extremely valuable for us, and I think it's one of the most important things to look for when investing with a sponsor, is how much of their own capital they're actually investing. We never put less than 10% of our own capital, just our family's money, into any deal, just so we're always directly aligned. On average, we have about 20% or just over 20% of the equity of the portfolio. So
Okay.
we really have a lot of skin in the game. We're looking at these deals like, very, very closely. And I think that's really important for investors looking with the sponsor. And then we haven't changed any of our promotes or preferred returns since the beginning. We've just kept everything the same. We have investors with us that are been with us for the full 33 plus years
Wow.
and that are in multiple deals. And also we do 1031 exchanges too.
Oh, you do?
Yeah. So when we sell a deal, we offer an exchange to go in our next deal. So we have people that have invested in our first couple deals that are now in their fourth and fifth exchange. Really tax efficient model. Been really beneficial for us and our partners. But that split is an 8% preferred,
Okay.
80-20, 80 to our partner, 20 to us, and that's what we've been sticking with.
From day zero. Wow. That's interesting that you guys do a 1031, because I know from a lot of like more syndicate models, right? It's kind of hard to do the 1031 efficiently, because you have a lot of investors and people want their money back, and you got to find the next deal, and there's depreciation that has occurred. So how do you effectively do that, and or why do you think that's a competitive advantage for you guys in doing that versus other funds that these people can invest their money in?
Yeah, I do think it has been a competitive advantage, and it's something that people like investing with us for,
Yeah.
because it's just super tax efficient. And with my father's background, he was a tax accountant, saw the 1031 exchange, so we knew that we were in this business for the very, very long term.
Mhm.
So you first have to have a company that wants to be in the business for a very, very long time, because you're exchanging all the way to the end.
Yeah.
And so, yeah, there's some complications that come with finding the deal, the timelines of the 1031 exchange. But with how many deals we're doing every year, we're buying 12 to 15 deals. We never have any problems with the 45-day identification period, the 180-day close period. And it's been a really, really good model for us.
What's your biggest fuck up? And I say that not in a deleterious way, but like where you learned a lesson where you're like, okay, I will not make that mistake again.
We had probably two ones where we learned some lessons.
Okay.
Yeah, the CMBS financing was getting pretty aggressive in 2006-7,
Mm-hmm.
and they were offering some extremely high leverage, higher than we typically would go, but the rates were so good and the market was really kind of trending that direction. So the two worst deals that had the lowest returns that we've ever done were extremely higher than we like to go leverage, bought right before the Great Recession.
Okay.
So that's when we took a step back and said, let's just keep it, under 70%,
Yeah.
maybe even closer to 60% average going forward. And that's what we've been doing.
So for the people who don't know, right, what obviously leverage is the amount of equity versus debt that you get in a property. Why would someone choose to do lower leverage versus a higher leverage if you can get a loan that will give you 80% versus a loan where you guys are going to do 60%? Like, what is the thesis behind why that matters and why you guys choose to go lower, just generally?
So in general, real estate's very cyclical. It goes up and down for many different reasons that are unpredictable. And we've seen many cycles. We've been through 4 cycles in our history. And if you have an 80% loan and the values go down 20%, you have no value left in your property anymore. And it doesn't incentivize you to keep the property, to do the right things. So when you have the lower leverage, you're not, historically, values have not gone down 30, 40 plus percent.
Yeah.
So we want to be in a safe place where we still have good equity in our properties. And also, more leverage means more debt service or more debt expense.
Hmm.
And those are just very, very high expenses that you have to pay on your interest rate. So that is another reason to keep the leverage lower as well.
Do you guys do interest-only loans?
We typically always do interest only,
Okay.
fixed rate, and somewhere between 7 to 10 year financing. But yeah, the interest only, that lowers your your obviously your payments and your expenses.
Yeah.
And then it allows you to have higher cash on cash as well because you have the lower expenses. So yeah, we typically always do interest only.
Why? And I'm just curious because the people who buy your LA properties are these NOAA buyers, right? Which for people that don't know, NOAA is basically this new investment thesis or practice of where you go and you partner with a nonprofit, right? And when you're partnering with a nonprofit, you get some benefits from your property taxes. And with LA, which is the biggest benefit, is you don't have to pay ULA transfer tax, which is a big one, which makes the numbers a little bit juicier. Have you guys ever thought about going into affordable? I know affordable is a big talk right now with California and light tech and the way that housing has become so unaffordable that there's a lot of programs, bonds, things like that, that is making it accretive from an investment model to go into this affordable stuff. Have you guys ever explored that? Do you think that that's interesting to you?
Yeah, we've explored it in the past a little bit more than we've explored other things like development that we talked about and other product types because there's always been ways to partner with nonprofits and get tax abatement. Just recently, they made it more aggressive and more and are trying to incentivize people to do it.
Yeah.
So just as we're starting to see these NOAA buyers come in the market, we've been exploring it ourselves too, because if we can get major tax abatement and then also other benefits too, it might make sense for us to do it on some properties we currently own or ones that we're going to buy. So we're early in the explorations, but it's something that we just want to at least understand and see if
Yeah.
it makes sense.
What about light tech?
Haven't looked at light tech at all. And just a much different business. And
It's
yeah, yeah.
It's like I feel like I'm working at McDonald's and I just got hired at Tesla and you're like learning everything. It is once you get it, I've been told. I had Jeff Jager on this and he's at Standard Communities and they do mostly everything capital A affordable. But I've had some deals that we've underwritten where they're light tech deals and I'm like, I have no idea how to value these things. Like I'm calling up all my peoples and like figuring out how to make these things work. It is textbook to understand how things move. It's the way money moves, right?
Yeah, no, we've looked into them very little, but yeah, there's a lot of restrictions. There's a lot of requirements. There's years that you can do things. I mean, yeah, it's a whole different business, really.
Have you ever done any sort of commodities hedging? So I've heard, and this is more from a buddy who used to work at an institutional industrial shop. They used to buy like puts and calls on certain, I don't know if it was like rates, but there was basically like a caller to help them with their interest rates to buy commodities and also hedge with their long-term rates on the debt that they have. Have you guys ever done any sort of creative money manipulation like that? I don't know if that's the right word, but
Yeah, no, we really haven't. We own 99% of our loans have been Freddie and Fannie, very traditional, the same that we've always done. In the really aggressive rate market of the 2021, 2022 time,
yeah.
we did start exploring life insurance company loans.
Okay.
And we put a couple life insurance loans on a few of our properties.
Mm-hmm.
The loan terms and the rates were amazing. And they had a lot more restrictions on them, like just a lot more tests, and you could be put into cash management where they hold your cash if you're not hitting certain metrics. So, now looking back, we got some amazing loans and the properties are doing very well, but there's a lot more requirements on those. So anytime you're doing something new, you really have to understand it and, dive deep into, every detail of it.
It sounds like being able to have control over the investments is a very high metric that you guys look at in terms of where and what you use to invest. Like, is that ability to control the situation and change things if they need to be changed or adjust here? Like, is that something that's really important to you guys when you're looking at how you invest holistically?
Yeah. And then as we talked about, putting 10+% of our own money into every deal, we want to make sure we're not making any mistakes on the expense side, on the revenue side, on income, really on anything. And then also we got to put the right people in place to execute well. So that's where the vertical integration comes in. So we can put the right people on site from the asset management level, construction management, property management, and really execute flawlessly.
Do you have any desire to do alternative investments just personally? Like, do you want to go invest in prop tech or VC or a brewing company, or, like, do you have any personal passion projects that you thought about investing in?
I've diversified my investments. Growing up in a real estate family business, we're always going to be extremely heavily invested into our company, into our real estate, but it's diversification is good for everyone. So nothing in particular, mostly just kind of general funds
Yeah.
and general indexes and more kind of general things.
Uh-huh.
But I wouldn't be opposed to it.
Okay. So
Yeah.
you're open-minded to it.
Yeah.
How do you decompress? Because I don't know, in terms of, you're running a very large business, right? There's a lot of people that you have to deal with, and I know people problems are a big thing that can cause some stress, right? How do you effectively continue to come back every day? Like, I assume, money's not an issue at this point in time. Like, you guys don't, you could probably just sit back and chill with the 32,000 units, and your dad could, go watch grandkids grow up, all that stuff. Like, why? One, first question, how do you decompress? What does that look like for you? And then two, why keep growing it?
We truly love our business, and we have three big stakeholders that we just love to see their lives improve in different ways. Obviously, our investors
Mm.
through good returns, our employees through good opportunities, our residents through places to live. So every day we love coming. My father will never retire. I plan to never retire. We want to do this till the very end, and that's been um, really fun and really enjoyable to do. And then on the decompression, I like staying pretty scheduled. I'm a very scheduled guy,
Okay.
so like waking up early,
Uh-huh.
working out. I have three young kids. They keep me super busy, and I'm a big golfer as well. So
Okay. All right. So you're getting on the links and
yeah,
all of that. Well, it's two birds with one stone in real estate, right?
yeah.
Because I'm sure not every golfing outing is with a real estate person, but there's nothing like getting on the links for 4 hours and getting to know someone, right? Like, it's really hard to spend. I like to call it I'm giving a talk to our office, and it's on networking and relationships. And I think of networking as a barbell. So there's the really short, like, memes you text your friends, or the article that made you think of someone, like these short, quick bites. The coffee meetings are like ideally you don't do the coffee meetings, because it's really hard to build a relationship with someone in 30 minutes, right? Or you do these long stretches of time. So 4 hours in the links, a weekend away, some sort of boating trip, something like that, right? So golf is an interesting place where you can kind of get that long tail of the barbell. How do you think about networking? How do you think about growing? Because you're networking with investors, you're networking with brokers, you're networking with maybe people you want to hire to bring on the team. Like, how do you approach that?
Yeah. No, the networking is one of the most important parts of our business for just many, many reasons. And golf, I love either way, but it's also nice that you can get to network with it
Yeah.
as well. And we're in Century City right now, so I was driving past Hillcrest and then LACC.
Yeah.
Both I've played many times. I was trying to see where the pins were, and it made me I should have brought my
Right.
clubs with me. But
Yeah.
yeah, networking for really every aspect of the business has been a big goal of mine. And it's really helped us grow our business through investors,
Mhm.
through other property owners that we've been able to purchase more properties from,
Mhm.
property buyers as well, and we're selling a deal as well too. I mean, in every way. I mean, networking is one of the main important aspects of our business.
100%.
Yeah.
Yeah. I mean, I was just talking to Nadine Watt, who was on the show previously, and she's like, we were talking about young people, like, what is the skill set that you should cultivate and try to grow? And she was talking about networking. And I said, I completely wholeheartedly agree. When you have a relationship with someone, because she was talking about back to office, because she owns an office building in Century City. And she's like, I think we're leaning more towards people wanting to come back in the office, because you don't get that, like, relationship over Zoom, or when you're working virtually. It's not, you don't build the relationships where networking is to be leveraged if you have an opportunity, or you introduce someone to someone. Like, there's nothing like that in person that I think is really hard to replicate from this virtual world. Are you guys, I don't think you own any office buildings, but is the office market affecting you guys at any point at all, are you looking into the other industrial, retail? Like, are you looking in the other sectors of real estate as well?
We sadly own one office building.
Okay.
Yeah.
Okay.
Yeah, the office building that we office out of.
Oh,
So,
got it.
yeah, we bought
Okay.
that in 2006. We've been there for 20 years,
Okay.
and we should have just put that money in apartments,
Yeah.
but, that's okay. It's helped us, grow. We've grown so much, and we've been able to move out, our other tenants and grow into a really big space, and it's worked out well, but it's just a lot of work for very little return, and the office market is extremely depressed right now.
Yeah.
So, but to one other point that you were talking about is just the work from home and the working in the office. Yeah, we really feel there's been something that's been lost with the work from home, and it's difficult to get people to want to network and be back in the office and
Mhm.
collaborate, but it's something that is a big mission of ours, and we plan on doing as well. And I know that there's a lot of companies that are doing that too. I went to work at CBRE for a few years after college, and just
Mhm.
being in that cubicle environment and overhearing conversations and learning and looking up, it's just so important. And
Yeah.
even being here today with you too, it's a networking opportunity, and really appreciate it and great to be here.
Of course.
Yeah.
No, totally. I understand. So you guys are not fully back in the office yet? You're working towards that? That's what you're saying?
We are, yeah. We've been slowly working back. The workforce is telling us that they don't really want it.
Yeah.
And at some point, you gotta rip the Band-Aid and make the decision.
Yeah.
And so, it's coming soon. And I know California, the government is planning on doing it next year, and lots of companies have been doing it. But right now, we're 3 days mandatory in the office, and those 3 days are supposed to be with your team, so you can collaborate, have your meetings. The Zoom meetings, they work fine and they're good, but, there's always a little glitch, or you can't hear
Yeah.
something, or it's just not, and it's just never perfect.
Ideas flow. I feel
Yeah.
like there's this flow that when you're in the same room, like good things are more likely to occur when you're bouncing ideas off each other. And with you guys trying to optimize every little piece, right? There's something that one person says and that sparks something inside of you, and you're like, wait, we should do that here, or there's a new style trend that's coming up. Like we should add this to our apartment amenities or anything like that. So I'm hoping that for you guys that the employees are open to it, because personally I think we were like 6 weeks out of the office in 2020, and I've been in the office ever since. I live in the office. If anyone is watching this and knows, they know that I'm a big fan of that. So it's good to know that people are moving in that direction too.
Yeah. No, I can tell that you love it here. Yeah.
I really do. Um, if we're looking 5, 10 years in the future, you're 30 years old. So you're starting over, right? No family business, but you got your relationships, you have the people that you know. Where do you go to build a company? Where do you go to invest in from a real estate perspective? Like, where are you going to find opportunity to build something massive?
Yeah, Mark, my father, was about 30-ish when he started our business.
Okay.
Yeah,
I'm
so
29. Holy shit. I got a lot of I got to catch up
yeah.
on some stuff.
So I know how old he is. So he was 34 then, because it
Okay.
was about 34, 35 years ago that we
Okay.
started the business. And I think that getting reps
Mm.
and fully understanding what you're getting into is going to be the most important thing. So
Mm.
going for the biggest company that's looking at the most deals, that's has the most activity, even if it maybe doesn't seem like the best opportunity or the best paying job at the
Yeah.
time, but just if you can see the most deals, understand what you want to do, and then you can go and try to start your own thing.
Yeah. And go and grow it. And I know I get a lot of people asking me, Taylor, when are you going to go, do investments? When are you going to go start a fund? When are you going to go syndicate? And I say, I'm pretty happy right now. Things are going well. The business is growing, but it's always in the back of your mind in terms of that leverage, right? The building equity. It's really hard to sell a brokerage business. You could get paid by a bigger company to come over, but it's not the same level of equity. And I'm a big believer in building something that has sale value, that has equitable value. So the investments are a logical route given my knowledge and expertise in what we've done, and you on the brokerage side before, to understand how that value can then lead into you going and investing, which is great. So um, before we wrap up, last thing, Jeff, for you, right? If you had a message to give to your kids, to younger people, to anyone listening to this, maybe people who want to start investing in real estate, maybe people institutional wise who are like thinking of doing their own thing, or they want to climb up the corporate ladder, like what piece of advice would you have, and or what piece of advice has been given to you that has changed the way that you approach your career?
I've learned a lot of really important lessons from my father, and I get to work with him every day, so I'm super lucky. But he always has taught me the importance of you're only as good as who you surround yourself with. So really building the best team around you is going to help you have the most success. And that's been something that we take pride in and is always what we're thinking to do is always hiring the best, working together as a team. And we've had so many good team members that have lasted all the way to retirement or 20 plus years.
Let me follow up on that. How do you find and convince good people to come work with you?
That's a little bit of getting people to believe in your vision. Yeah. So back to the being the best at one thing and really focusing on it. We have a very, very clear vision, and we can show them our past and how it's where we've gotten to and what we want to do in the future. And people want to join and jump on the train and see where it goes.
Okay, last question. What is the business's MG superpower? Like, what gives you guys the edge? And I know you said you have a clear vision, you're vertically integrated. Obviously, you have scale, but like, if you really think about it, like, what is the secret sauce? What is that superpower that you think gives you guys the ability to do what you do?
We've talked about it a little bit, but I do think it is the hyper specialization into one thing and just ultra discipline is what I would say. Just unbelievably disciplined.
Amazing. Jeff, thank you very much. I appreciate this. MG Properties, go check them out. If you're looking to invest, they have great returns. They've done very well, never lost money, besides one, but we're going to kick that aside. Thank you very much for being here.
Appreciate it. Great meeting you. Thank you.